In 1979, at Princeton University, psychologists Daniel Kahneman and Amos Tversky conducted a series of experiments that would forever change our understanding of human decision-making. They presented participants with simple choices involving money, where the mathematical outcomes were identical, yet the human responses revealed a startling and irrational pattern. When offered a guaranteed gain versus a gamble, most people chose the certainty of the win, acting in a way that seemed perfectly logical and predictable. However, when the experiment was reversed and participants faced a guaranteed loss versus a gamble, the majority suddenly preferred to take the risk. This shift proved that people were not just calculating expected values. They were being driven by an intense, visceral fear of accepting a certain loss. Kahneman and Tversky measured this asymmetry and found that, for the human brain, a loss feels approximately twice as painful as an equivalent gain feels good. This phenomenon, known as loss aversion, is not merely a personal quirk or a lack of education. It is a fundamental, reproducible, neurological fact. It represents the standard hardware of our entire species, a survival mechanism evolved over millennia to help us avoid danger in a primitive, unforgiving environment. But when this ancient hardware is applied to the modern stock market, it creates a dangerous disconnect between our biological instincts and our financial goals. Consider an investor holding two stocks, one that has risen by 30% and another that has plummeted by the exact same amount. Rational financial theory suggests selling the loser to rebalance the portfolio, yet most investors do the exact opposite by selling the winner instead. They do this because selling the losing stock forces them to confirm the loss as real, which triggers a painful response in the brain's neural circuits. In fact, neuroimaging shows that the brain processes the realization of a financial loss using the same pathways associated with physical pain. This explains why even highly educated professionals, including finance professors, often make disastrous decisions during periods of extreme market volatility. During the 2008 financial crisis, many experts sold their assets at the absolute bottom, driven by the same primitive fear that once helped us avoid predators. Even while performing complex pencil and paper calculations, the brain continues to fire off danger signals that eventually override the rational prefrontal cortex. But loss aversion is only the first layer of the problem. The second mechanism that sabotages our wealth is a phenomenon known as present bias. The human brain is wired to discount the future dramatically, making it incredibly difficult to prioritize long-term security over immediate, short-term gratification. Research consistently shows that people prefer a smaller amount of money today over a significantly larger sum in 12 months, which defies all logic. From a neuroscience perspective, this is not absurd at all, because spending money today activates the brain's powerful reward and pleasure circuits. Conversely, saving money for the future activates the same neural regions associated with losing something, creating a persistent internal conflict. For your brain, your future self is essentially a stranger, making it an exceptional act of willpower to sacrifice comfort today for someone you haven't met. Beyond these two traps lies a third, perhaps the most expensive of all, the persistent and dangerous illusion of control over complex systems. One massive study analyzed the trading records of 66,000 individual investors to see if their constant activity actually led to better results. The results were clear. The most active traders, those who researched obsessively and monitored their portfolios daily, earned the lowest annual returns. These investors underperformed by approximately 7% per year, a gap that, when compounded over 3 decades, results in a staggering loss of wealth. This happens because the stock market is a complex, adaptive system where millions of participants are constantly reacting to the same public information. Every asset price already reflects the collective intelligence of the entire market, making it nearly impossible for an individual to gain a sustained advantage. Your research does not actually beat the market. Instead, it provides you with the comforting yet expensive feeling that you are in control. The Harvard professor who sold at the bottom was not stupid. He simply possessed a brain designed for survival, not for navigating modern financial markets. The alarm system in our heads produces the exact same response to a portfolio decline as it would to the sudden appearance of a predator. When that alarm sounds, the brain produces one singular urgent answer: get out, sell everything, and protect what remains at all costs. This is not a character flaw or a sign of weakness. It is the right biological system running in the wrong, modern financial environment. The fundamental problem is that simply knowing these mechanisms exist is not enough to stop them from influencing our daily financial behavior. Awareness, as Kahneman discovered, does not reduce the impact of loss aversion, because our intuitive system 1 acts much faster than our rational system 2. By the time you are consciously aware of the situation, your brain has already been influenced by these deep-seated, automatic, and emotional responses. So, what is the solution if thinking harder about our money does not actually solve the problem of our own biological wiring? The answer is not to rely on willpower, but to build structural systems where our impulses have no room to make decisions. By automating your savings, you remove the choice entirely, ensuring that present bias cannot intervene and disrupt your long-term financial progress. You should also write down your sell rules during a calm moment, so that when the market alarm sounds, your pre-written plan takes over. Reducing your portfolio access is another powerful tactic, as it limits the number of opportunities the illusion of control can act upon. The investors who consistently perform well are not necessarily the smartest people in the room, but the ones with the best pre-commitment structures. They recognize that their brains are not built for trading, so they create environments that protect them from their own natural human tendencies. By outsourcing the decision-making process to automated systems, they effectively bypass the emotional traps that cause others to fail so spectacularly. This approach requires humility, acknowledging that you are not immune to the cognitive biases that have defined human behavior for thousands of years. It is about designing a life where your financial success is not dependent on your ability to stay calm during a market crash. When you accept that your brain is a tool for survival rather than a calculator for stocks, you can start building a more resilient strategy. The goal is to create a set of rules that function even when you are feeling the intense pressure of a declining portfolio. These structures act as a buffer, preventing the emotional alarm from triggering the panic-driven actions that destroy long-term wealth accumulation. It is a shift from trying to master your emotions to mastering the environment in which your financial decisions are actually made. This is the true secret of the most successful investors. They treat their own psychology as a variable to be managed, not ignored. They understand that the market will always be volatile and that their brains will always be prone to fear, greed, and overconfidence. By planning for these inevitable reactions, they ensure that their money remains safe regardless of what the stock market does tomorrow. So, stop trying to outsmart the market and start trying to outsmart your own biology by building systems that keep you on track. The most effective financial strategy is the one that requires the least amount of active emotional intervention from you as an investor. Remember that your brain is a relic of the past, but your financial future is something you can build with modern, structural foresight. Embrace the reality of your limitations and use that knowledge to construct a path that leads to long-term growth and stability. The path to wealth is not paved with intelligence or constant monitoring, but with the discipline to automate your success and ignore the noise. By doing so, you can finally align your financial actions with your goals rather than letting your ancient instincts dictate your outcome. Ultimately, the best investor is not the one who knows the most, but the one who has the best systems to stay the course. The core problem is that simply knowing these cognitive biases exist does not prevent them from influencing our daily financial behavior. Our rapid response survival systems operate much faster than our rational, analytical minds, often bypassing our logic during moments of high stress. Even highly educated experts are not immune to these primitive alarm signals when they are faced with sudden, perceived financial danger. Consider the famous Harvard professor who sold all his assets at the absolute bottom of the 2008 market crash in panic. This illustrates that intelligence is not a shield, as we cannot rely on willpower alone to overcome our deep evolutionary programming. These deep-seated instincts have been refined over 200,000 years, making them incredibly difficult to override with mere conscious thought. Because our brains are wired for survival rather than complex market analysis, the only effective solution is to build structural barriers. We must create systems that remove the opportunity for these biases to act, effectively taking our emotional impulses out of the equation. Success in financial markets is not achieved by thinking harder, but by implementing rigid pre-commitment structures during our calmest periods. Automated savings plans ensure that our future security is prioritized before our present bias can tempt us to spend the money. Establishing written sell rules while we are calm prevents us from making reactive, emotional decisions when the market begins to fluctuate. Restricting portfolio access creates a necessary friction that stops us from constantly tinkering with investments based on short-term market noise. Ultimately, the most successful investors are not necessarily the smartest people, but those who design systems that protect them from themselves. By acknowledging our human nature and building around it, we can finally stop our biology from sabotaging our long-term financial goals. Think of your brain as a dual processor system, where the ancient emotional core constantly competes with the newer, logical prefrontal cortex. When the market drops, the ancient core screams danger, effectively hijacking the decision-making process before the rational mind can intervene. This is why awareness alone is insufficient. The alarm has already sounded, and the physiological response is already well underway. To win, we must stop trying to win the argument with our own brains and start changing the environment we operate in. By automating our contributions, we remove the choice entirely, ensuring that our future self is funded before our present self can interfere. Writing down an investment policy statement acts as a contract with your future self, locking in your strategy before panic sets in. When you encounter a market downturn, you simply follow the pre-written rules rather than relying on your compromised, panicked intuition. Reducing the frequency with which you check your portfolio prevents the illusion of control from triggering unnecessary and harmful trading actions. The goal is to create a set-it-and-forget-it architecture that functions independently of your fluctuating emotional state. By designing these guardrails, you effectively outsource your discipline to a system that cannot feel fear, greed, or the urge to panic. True financial mastery lies in recognizing your limitations and building the structures that allow you to succeed despite your biology.